Our next teacher traded cryptocurrencies and commodities at various Wall Street firms in both New York and Singapore for 14 years. In 2018, he joined ShapeShift as the head of trading and portfolio risk. It's my great pleasure to introduce Clark ShapeShift. Guys, put your hands together.
Thank you, and thanks for the introduction, Shannon. Thank you to all the C4 people who are putting the conference on. It's been great, Michael in particular. So my name's Clark. I started my career at Lehman Brothers back in 2005. I traded FX and commodities and interest rates at a number of different banks over the course of the past 15 years. Caught the crypto bug about 2 years ago or so, and joined ShapeShift as head of trading and portfolio risk. So I'm excited to be here today. First thing is to get the disclaimer out of the way. This is not financial advice. Speak to your direct individual advisor if you're looking for specific things, but hopefully we can go over some general principles of trading and investing that can help you guys out. So to dive right in, we got the agenda. I don't need to go over each thing point by point because we're going to go through it, but you can refer to that afterwards. I've uploaded the slides so you can check them out. So we're going to start, let's start with a quick question. So how many of you, I imagine most of you are crypto holders, how many of you are hodlers and don't trade very actively at all? Okay, now show of hands, how many people trade a little bit more actively, like a few times a year or once a month or something like that? Okay, and then do we have any die-hard active traders in the room as well? Okay, great. So we've got a decent mix here. So this presentation that I'll go through for the next 20 or 30 minutes is mostly geared towards people who have more of that hodler's mindset and might potentially want to get a little bit more active, but they're not the type of people who are in there looking at Ichimoku clouds every single day and all that kind of stuff. I'll open it up for questions towards the end, and we can certainly address any of the more complex questions that we have about some of the more advanced trading techniques. But to start, I'm just going to start with, it sounds simple, it almost sounds like a cop-out, but dollar cost averaging is the best baseline strategy to use if you're looking to invest in any new asset class, crypto included. So what I mean by that, is it's as simple as something like if you work at a crypto company and you elect to get X% of your paycheck in crypto every 2 weeks, and it's a set amount at regular intervals. That way you can dollar cost average into an average rate over the course of the year. It takes out all the emotion associated with investing like that, and it also builds into the best average that you can possibly get as a passive investor like that. So in addition to being able to spread purchases out by time, like I mentioned in that first bullet, that's the most simple way to go about it. You could also potentially spread your purchases out by price. So if you're in the 2017 mania, Bitcoin's going from 15,000 to 18,000 in the matter of minutes or hours, you can say, okay, it probably doesn't make sense for me to panic here. I want to be more patient. You can pick certain levels where you bid on the way down. So Bitcoin, in my example, 10,000, 8,000, 6,000, 4,000. Just stagger it out at regular intervals. You can also combine those two strategies of price and time. Just be careful because the less systematic you make your strategy and the more emotion, the more you put your finger on the scale, the more variable the performance of that strategy becomes. So let's say you've mastered dollar cost averaging or you're getting paid every 2 weeks in crypto. You want to get a little bit more active. You fancy yourself someone who can predict potentially where the market can go in the next few months. You might be a master of sentiment. You might understand some of the fundamentals, or you might even start to look at technicals. If that's the case, then you might want to move towards a slightly more active strategy. The way that I would think about this is think of your entire bankroll. Think about the amount that you want to invest into a particular asset or into a basket of crypto assets. Work your way into 50% of that total size using the passive strategies outlined dollar cost averaging in the slide before. So you're basically working your way into a quote-unquote core position. That's going to be like your benchmark position. If you don't have a strong opinion about the market, I would advocate to just hold 50% of your total and then just wait for new opportunities, new catalysts to come up. So depending on what your investment strategy is, whether it's fundamental or technical, et cetera, you want to define bounds for when you want to change your allocation. So 50% is the core allocation. If you're max bullish because you thought we just saw a huge sell-off, or because you think a new ETF announcement is going to come out, or a new regulatory announcement, that kind of thing, then maybe you want to up it to 75% or 100%. Vice versa, if you think that the SEC is going to crack down further on ICOs and people are going to go to jail, maybe you get out of the market entirely. So that process that I outlined is more of a fundamental approach. You can also take a technical approach. A lot of people get scared off by candlesticks charts and crazy stochastic modeling and all that kind of stuff. Really, technical analysis for the purposes of the simple passive investor like this can be defined as two major buckets. You've got one bucket that's going to outline when you're in a breakout environment, and another bucket when you are going to identify the fact that the market is stretched too far and it's more likely to revert to the mean. Okay, so you can use, there's all kinds of different indicators in that regard. Some oscillating indicators that indicate overbought and oversold that might help you define these buckets include things like RSI or MACD, whereas some of the more breakout-based indicators are things like trend lines, particular patterns in that regard on charts. And then something like Bollinger Bands, for example, too, that uses standard deviation of price. I'm happy to get into that in one-on-one afterwards if you guys would like, or if you want to follow up with me directly after the show, or the speech, rather. And then we can also address it in the Q&A as well. So I'm going to go through, if order books look like a crazy foreign language or alien language to you, this should hopefully help you get just a basic understanding of what some of the terminology is, the vocabulary around order books, and then some of the basic order types after that. So when we refer to someone who wants to buy crypto, you can use the term long. You're long an asset, means you own it. You can say you're bullish that asset. In FX, the standard terminology for it was going paid, which means it was rallying, it was going up. And also, if you want to buy a little bit lower, you would stick in a bid. So vice versa, on the sell side, it's just the analog for each one of those, or the converse, rather. You're short, you're bearish, the market gets given, means it's going lower. And if you want to sell higher, you stick in an offer. So in the bottom half of the chart here, you have a little diagram outlining some of the terminology around order books and entering orders. So you might have seen some of this before. Some crypto exchange ecosystems are pretty straightforward and simple compared with traditional asset classes, but most of them have at least this basic functionality. So just walking through the life cycle of a trade, if I was bullish Bitcoin, on the bottom left there, I would go in and buy a new position. So then what happens? How do I actually go about managing that risk appropriately, right? If you're just using the dollar cost averaging strategy that I laid out, then it's straightforward. You don't need to worry about a stop loss, at least until the market changes on a longer term basis and you want to take the trade off. But if you do want to put some more short-term parameters around it to manage the risk, then if you were to buy a position in Bitcoin and go long, if the market were to go up, you'd be making money. So as a result, when you close that position and sell out, you're leaving a take profit limit order. Okay, so all exchanges support that type of order. That's basically what makes up the order book. It's all the bids in the order book and all the offers in the order book. On the flip side, if the market goes against you and starts going down, you're at risk and you're losing money. So as a result, if you wanted to close that position out, you would leave a stop loss order. Now, like I mentioned before, take profit limit orders are very easy to manage risk for, because you just say, hey, if Bitcoin goes up to 50,000, I want to sell some. You can leave that order in the book, and all those orders form up the order book. It's much, much trickier to manage a stop loss order. So back when I was in the FX days, we would watch these orders manually. A customer would call up and say, hey, if the euro goes down to 105, I want to sell 100 million euros. I would have to sit there with my finger on the trigger and wait until the euro traded 105 and then chase it to try and minimize the slippage. So now there are some automated technologies that try and replicate that risk management, but they do it with varying degrees of success. There are always trade-offs, because you can't just say, if Bitcoin goes down to 3,000, I want to sell all my position and stop out. Well, what happens if no one wants to buy at 3,000 and the market goes to 2,000? You're out of luck. You've got your whole position. Or what happens if all the bids evaporate and the best bid in the market is for $5? You might end up, if you leave a stop loss there, selling all the way down to $5, which clearly you don't want to do, and then the market's right back where you left your stop loss. So there's two different ways you can manage a stop loss, or most crypto exchanges at least have them. There's a stop loss limit order, where you can say, if Bitcoin goes down from here to 3,000, I want to get out, but I don't want to sell any worse than, say, 2,500. That way you run the risk of the next price is 1,000 and you're still in your position and you didn't get stopped out, but it also puts a control on the downside price that you're willing to sell at, so that you don't end up causing a flash crash by mistake. And the other way to do it is just a stop market, where as soon as that level trades, it just goes and hits the next bid. You're more likely to get out of your position, so it's safer in that regard, but it's much riskier in terms of price, because you could end up hitting any low price. So then the chart on the right, or the diagram on the right, is basically the flip of that, the inverse. If you sell and go short a cryptocurrency, then that's a new position. If it goes up, then the market's going against you, and so you'll be buying back at a loss, so that's a stop loss order. And if the market goes down, then you're making money, so you would be leaving a take profit limit order. So that was quick and a lot, I know, but there's two more types of advanced orders that cryptocurrency exchanges are starting to introduce into the ecosystem, and I thought it would be helpful for you guys to go through those two. I've seen them on a couple exchanges starting to pop up. The first one in the top left is if done. So let's go back to our example on the bottom left there. you can say, I could leave an order on a couple of these exchanges now, and it should be more widespread going forward, where it says, if Bitcoin goes down to 3,000, I want to buy. And if that order gets filled, then I want to leave a stop loss below that at 2,000. So that's basically like, if one order is done, then institute the next order onto the exchange as well. And then in the top right, the second example of a more complex order type is, so take that bottom left example again and say, if I were to buy at 3,000, I want to either sell, if it goes against me on a stop loss down to 2,000, or if it goes up, I also want to leave a take profit. But you want one of those to cancel the other because you don't want too much risk. Once you've opened the position and closed the position, you obviously want to cancel the remaining order. So that's an OCO. So you can actually combine those together, like I just described, to have an if done and then an OCO after that. So in the traditional world, it doesn't just stop there. It also comes down to, or more advanced strategies have started to be spun up. Basically, all of these strategies are used to minimize market impact when executing, like I said there. The fancy term for that in the trading world is implementation shortfall. I'm sure you guys have probably heard of the term slippage. The term slippage, when you go to execute an order, regardless of which venue you use, is the difference between the price that you look at on CoinMarketCap or CoinCap when you set out to deal, and then the actual price that you get when you hit the buy button. So all of these order styles below are designed to minimize slippage. Most of the time, you don't get retail venues that give you these tools, so you either need to plug into an institutional counterparty who can manage that for you, or you need to find a more advanced venue where they offer this type of thing. The first one is smart order routing. We do this at ShapeShift. It's basically a way to aggregate various order books and then route trades through in the appropriate fashion. There are a lot of different complex ways to do this, and there are also some simple, straightforward ones. I'm happy to talk more about how we do that afterwards as well. And then there's just some simple algorithmic execution strategies there, a TWAP and a VWAP. They are as described. It's pretty straightforward. If you have 100 Bitcoin to buy over the course of an hour, a TWAP algorithm will generally just break that up into individual pieces over the course of the hour. Again, there are simple ways of executing that. You can just do the division and do it yourself manually to spread out the execution risk and the slippage risk. Or there are more advanced algorithms out there that will randomize the time frequency and randomize the amounts that get done over that period in order to disguise that from the market. Because if I'm sitting there listening to the market as a market maker and I see regular large intervals come in, I can just ride those and front run them according to how they come in. So randomization. And then the final one is a VWAP. That's basically the same thing as a TWAP, but it's just executed in different venues depending on how much volume they do. So just weighted by volume. What do we got next? Okay, so this gets into the meat of proprietary trading, just across the board. It kind of outlays the different buckets. People will talk about it, and people will apply to work at ShapeShift, that kind of thing, and they'll say, well, I do arbitrage. And I say, okay, well, what kind? And a lot of times I get a blank look. A lot of times, people just don't really know that there are all these different types of arbitrage, proprietary trading, market making out there. So the one that I'm most comfortable with that I've always done for my career is that first one on the list, discretionary macro trading. It's basically a fancy term for thesis-driven investing. Bitcoin as digital gold is a great example. It's probably the best example so far that we have in crypto that's taken hold in the traditional investment community as well. So generally, when I was a trader, I always used to like to say, I sat next to one guy at Lehman Brothers who was our technical analyst, and he would say, you can show me a chart of any asset and take the label off, and I'll tell you where I think it's going. The asset doesn't matter. The fundamentals don't matter. On the other side of me sat this other guy named Jim, who was our Mexico trader, and because he was an emerging markets trader, his view was the exact opposite. He said, I'll only change my position when the fundamentals change. And he laughed at technical analysts and said they were all garbage, right? So now each one of these guys was making 7 figures a year. They had directly opposed views about how to trade the markets, and both of them were successful and made a bunch of money. So the moral of the story is some combination. Most traders end up in the middle on that spectrum somewhere. I always like to have a fundamental basis for a trade idea that I would put on, and then I would use technical analysis, simple tools, more complex tools, as confirming indicators to tell me when I was right, when I was wrong, how big my position should be, all that kind of stuff. The mix is different for everyone depending on what type of investing you're trying to do and where you've had success in the past, what your skill set is. So the second bucket there on the list is VC. You'll find that a lot of crypto firms, hedge funds, asset managers, that kind of stuff, will take like kind of a bilateral approach between investing in underlying tokens of projects, and then sometimes even investing in equity for the company or the protocol itself. Obviously we've seen that with mixed results in 2017 with the ICO boom and bust and FAQ protocol layers, all that kind of stuff. So then you'll find some firms or some traders out there that are purely technical. So you can end up building systematic models for those two environments that I mentioned in the previous slide, which are trend-following momentum breakout models that do best in times of high volatility. And then opposed to that is mean reverting, contrarian range-bound based models where you think things are overstretched and you end up trading extremes and taking a contrarian viewpoint. So then you get into more institutional market-making businesses. You've got on the one side the high-frequency traders out there. There are big firms doing that. Obviously, they're trying to co-locate servers, reduce latency as much as possible. Some names include Citadel, Jump, Virtu. There's dozens and dozens. A handful of them have actually gotten into the crypto space as well. We continue to see more and more participate both in the futures markets as well as in the underlying spot markets. And then finally, you get direct-to-consumer, basically, customer-facing market makers. You end up with names like Robinhood or Abra or ShapeShift. That's what we do. And then finally, there are various forms of arbitrage, like I mentioned. Happy to dive deeper into each one of these buckets if anyone's interested. The first one is triangular arb. That's a classic one from currency trading as well. When I first started in the currency markets, Wells Fargo was known for their arbitrage traders or triangular arbitrage traders because they would set up all these different trading exchanges for crypto, or for FX rather, on their desk, and they would have keypads on their desk as well, about 6 or 7 of them spread out, and they would just keep their hands locked to their keypads, and as soon as they saw things come out of alignment, they would just do manual 3-way arbitrage. So basically, triangular arbitrage is you have Bitcoin trading against the dollar, you've got Ether trading against the dollar, and then you've got Bitcoin trading against Ether. Certainly, sometimes based on supply and demand, those things can get out of whack. And so now, obviously, it's much more automated than it was back in those days. But you can have a computer program that basically just makes that marketplace more efficient by buying and selling to have zero net risk, and make some profit. The second thing is probably one that people are most familiar with in crypto, which is exchange arb. So just across different venues, there are all different reasons why exchange arb could happen. You have certain exchanges with cloud infrastructure versus others with hardware and co-location. You've got some that obfuscate certain information about the marketplace, so the marketplace becomes more illiquid. You've got all different reasons why different venues might have different prices for a certain asset. The third one, regional cross-border arb. This is also a massive one in crypto. I'm sure you've heard over time about things like the kimchi premium, where if there are onshore capital controls in a country like Korea or like India is another big one, or if they've cracked down on crypto investing overall. I know, won't say names obviously, but a guy who was Korean nationality and was carrying suitcases of cash across the border. I think Arthur Hayes, famously from BitMEX, was doing a Shenzhen, Hong Kong regional currency arb back before he started BitMEX. The fourth one is statistical arb. This is a traditional one in equities. It's been used a lot. It's a little bit tricky in crypto because generally speaking, everything trades with each other. Everything's very highly correlated. You've seen some disparity now in Bitcoins versus alts, and you've seen alts sell off recently in the past 6 months, but by and large, one alt is pretty much like the other when it comes down to the math behind it. And we define that in trading terms as beta. So it's really tricky to strip out alpha, which is real value gained, from that market-wide beta. In equities, this was always famously expressed in pairs trades. So you could say historically the stocks of Ford and GM naturally trade kind of in line with a certain spread or a range of spread between the two. And so lots of stat arb desks would go out there and say this gap is wider than it's been statistically over the course of the past 5 years. So they'll buy one, sell the other. It's much less risky, obviously, from a net long perspective on the markets to do that kind of trade than it is to just buy the stock market or just buy one of those stocks. And then finally, you've got latency ARB. This is relevant in crypto as well, just because so many of the crypto firms have obfuscated cloud architecture about where their servers are and everything like that. So you can, generally speaking, it's also very, very relevant for DEXs, where you have on-chain trade settlement, and then you have an order book that kind of lags, and there's some front-running opportunities and opportunities to arbitrage different currency pairs across venues based on latency. All right, so venues to acquire and trade crypto, I just think there's a lot of confusion overall, including even in-house at ShapeShift, about, well, what do these different firms do? Where do they sit in the ecosystem? Some things map to traditional finance and some don't. Obviously you had crypto OGs getting involved in the marketplace before you had people with traditional finance getting in the marketplace who had all the vocabulary down. So there's all kinds of confusion about, well, what is an exchange? What is a DEX? All that kind of stuff. So I thought I could go into that a little bit, and I'm hoping that there's 1 or 2 questions about that, so we can certainly define that more specifically. So the first way to acquire and trade crypto is very manual, obviously, through forums, I forget all the names of them, but back in the day, I think that was where the lion's share of Bitcoin trading happened, ATMs, et cetera. The one that people are probably most familiar with is exchanges. So generally speaking, in traditional markets, this is a key point, exchanges function in an agency capacity. And so what I mean by that is exchange for crypto generally is a venue where a buyer and seller can come to meet, and the exchange doesn't bear any of the actual market risk. They just match the buyer and the seller, and they take a fee for that. That's contrasted directly with the final bullet there, which is market makers. So the market makers are the principal investors in the marketplace actually buying and selling. So unlike Coinbase, where I can go in and one of my ShapeShift colleagues in the back can go in and we can meet each other and buy and sell, when someone comes to ShapeShift to trade with us, we are the counterparty on every single trade. We manage the underlying market risk. So as a trader, to me, that's much more fun than selling software, managing a huge portfolio of risk, obviously. But different people have different versions of what they think the most scalable option out of that is, or the best way to manage risk. It's certainly easier. So for the end user, that is. So that's kind of what I wanted to do finally, is to go through what we do at ShapeShift, kind of the value proposition that we have, and how that compares to some of the other venues where you can trade crypto. So first and foremost, we've launched a new platform recently. It's a holistic platform where you can currently use hardware devices, a KeepKey or a Trezor. We've got some other stuff in the works for software and other hardware devices to store your crypto safely. So it's all self-custodial. You can track prices of your crypto assets natively in our platform using our CoinCap market data service. You can send and receive, obviously, like you could with any other wallet. And you can actually trade crypto on here. So that's the most compelling part to me and to our users. We're hoping that we get a massive wave of users coming in once they appreciate and realize how powerful this thing is, because we are trading as a principal market maker in this platform. And so what that means is that you don't have to manage 10 different KYCs, 10 different exchanges counterparty risks, compare all the different things, develop your own algorithmic strategies, manage all that risk across the board. You can just show up and say, hey, I've got Ether, I want Litecoin, and then we spit back out the price that we can take that risk at. You click the button, you send it to us, we send you the other coin, and that's it. So, I like to bill ourselves as the head of the trading desk. I like to say that we're the premier gateway for retail traders to obtain access to institutional grade liquidity in a really, really straightforward and easy fashion. So I think that's it. Thank you guys very much. So yeah, that was a lot to go over. Any questions? Sean? Yeah, absolutely. So Sean asked, how would you recommend traders to think about things driving the market? Which pairs or which assets or which venues are driving the market, whether it's all USD based, whether it's BTC based. A lot of it now actually is Tether based, just given how, how much Tether is flowing through the ecosystem. It kind of depends. Correlations come and go. I guess from a trading perspective is the way to look at it. So you can certainly do back testing. We can do it at ShapeShift at an institutional level. But anyway, you could just get historical price data that's open source and start to determine some trends quantitatively if you want, or even just qualitatively. You can just try and do some like Google Analytics even to see what people are, some social media scraping basically to see kind of what's trending in the marketplace. And then you can look at volume by venue, I'd say, as well. And you can start to see, well, what are the main drivers? What are leading and lagging indicators across the marketplace? And then from a risk management perspective, which you didn't really ask about, but I think it's important, when I worked at Barclays, for example, we had our profit and loss, our P&L was all based in pounds. And it was really like tough to come to terms with, right? Because it was just like a different benchmark. So we kind of do a similar type of thing, have some of our operational accounting in Bitcoin at ShapeShift. I imagine a number of other crypto companies do as well. So I think it's important as an investor to determine, well, like, what's your benchmark really, right? Do you know that you want to be in crypto and you want to invest $1 million over the course of your life in crypto? Then you might want to have, if you've got that long-term philosophy where you're always going to be in the crypto markets, maybe it makes more sense to use Bitcoin as your benchmark then to determine what your performance is. If you're just kind of in and out and end up having to, pay the rent or whatever, and you've got to sell out into fiat, then maybe it makes much more sense to keep your balance sheet basically in USD. So we don't do any 401k based, we kind of shy away, at least at this point, from any type of financial planning type business. We try and leave that to individual investment advisors and that kind of thing. That's why we don't do fiat-based stuff at the moment. We partner with Wire for a fiat on-ramp, but for now it's just crypto-to-crypto trading. We're introducing transaction history so it makes it easier to do your tax bill, but we don't have any actual tax advantage structures native within our platform, at least yet. That's a great question. So the question is, what do I think about atomic swaps? My opinion about this is, we spent a lot of time in this conversation talking about various venues to find price, really, right? To find liquidity, which means if I want to buy Bitcoin, where do I go to get that best price? So because ShapeShift is a market maker, I don't see us as being disrupted by things like decentralized exchanges or like atomic swaps, because it's really just the settlement layer for transactions. And really the participants in the marketplace are the ones who are enabling price discovery and actually managing the risk. So I welcome the introduction of any more efficient ways for me to trade with you. Whether it's me on my own, sitting at home, or whether it's me as the head of trading at ShapeShift offering that service to our customers. We've even explored different solutions for moving things around the ecosystem, like partnering potentially with Liquid to move our money around exchanges, or partnering with the people at Arwin to open up channels that have much less friction, like second layer, basically. So I welcome that. I'm excited about it. Sure. So the question is, who are some of the top market makers out there currently in the crypto ecosystem? And then he asked also about our smart order routing technology. So to answer the first piece, it kind of comes and goes. You've got a lot of upstarts and new entrants and that kind of thing. Like I mentioned, there are some high-frequency trading firms that are starting to drip feed into the marketplace. The traditional players in high-frequency trading are names like Susquehanna and Jump and Jane Street, and Alameda now is a spin-up off of Jane Street to trade crypto. So some of those types of names are starting to enter in the marketplace. They're entering into very selective venues. I'm not sure if you follow this FTX project, which is started by the Alameda guys. I would definitely check that out. That's certainly going to be one of the venues where the high-frequency traders are going to start to trade, just because the architecture is set up in a way that favors them. It's a guy who used to work at Jane Street, left and started Alameda. They're making markets in their ecosystem. So it goes back to what I was talking about, that agency principle conflict. In the crypto ecosystem, you sometimes get situations in which people are doing both. They're matching buyers and sellers. They're also pushing flow through their platform. A lot of the big names are doing that. Which kind of raised my eyebrow when I first walked into the space, because I was not familiar with that model at all. But, young markets need to evolve. People need to bootstrap liquidity. So it seems like that's kind of the way it's working out for now. And then the second piece of your question was about smart order routing. So we use I'll answer your question a little bit more generally. We use a number of different technologies, liquidity venues, partners, all that kind of stuff to manage the underlying risk that we have on our balance sheet, as well as the risk that we get incoming from our customers. The more that we can scale our business and get more volume in the door, tighten our prices, the more liquidity that naturally comes into our ecosystem, because you got more buyers and more sellers coming in, and we can figure out what to do with that risk. So the smart order router in particular, it basically takes, any smart order router, including ours, takes disparate sources of liquidity and aggregates them together, and then figures out the most efficient way to execute a trade across those venues. So some of them do it on a volume-weighted basis. They'll say, okay, well, 75% of the volume in the last 3 days has gone to Binance. So over the course of the next hour, if I want to execute a big trade, I'm going to break that, send 75% of it to Binance. And there's all different types of nuanced and complex ways that companies go about that, market makers go about that. There are some that are available directly to retail investors, but the friction there is that you have to have your own exchange account for each one of those exchanges. They'll integrate it for you, and then you also run the risk because you have to give them the API keys. So it's counterparty risk with them, where if theoretically someone were to get those API keys, they could go into a very illiquid venue, pump up Bitcoin to 50,000 and sell it to themselves. Right? So there's a lot of risk associated with using those different types of things. We try and abstract that risk out of it, just to say, here's your price, deal with us, and you don't have to worry about it, basically. So we use that amongst other tools to manage the risk. What's the advantage of a non-custodial exchange? So the biggest one is counterparty risk, obviously. If you've got your money on Mt. Gox, we all know how that ends, in tears. If you're holding your money yourself, then a place like ShapeShift becomes trust minimized. So there is still a small layer of trust in the ecosystem where when you want to do a trade with us, you send us your funds, and then we send you the other coin. But that trust is miles lower, orders of magnitude lower, than just keeping your money somewhere else all the time. And in addition, we're always exploring new ways to integrate with new technologies, as John asked about, with atomic swaps and second layer solutions, where even that level of trust minimization is probably going to be reduced closer to zero in the near-term future, I'd say, going forward next year or so. That's a big question. The question is, how does the FX market compare to crypto? So the main thing that drew me to work into this space was it was a great way for me to use my skill set as a trader but applied in a new capacity, in a new context, right? And so there are a ton of similarities between the way the markets operate. You know, you end up with a lot of FX risk in some of these venues even, right? Where you can trade against the euro or the dollar, and then you have euro-dollar risk in there, et cetera, et cetera. Overall, the answer is it's obviously much, much more liquid, right? One of the other main reasons why I wanted to get into crypto is because the FX market is the most transparent, commoditized, liquid marketplace in the entire world. So as a result, there's much less margin in the FX market than there is elsewhere. And so I wanted to completely blow that up and move into the exact opposite, where you've got no liquidity and all the volatility. You think about, so volatility generally in FX is expressed in percentage terms, in implied volatility terms. So 1 month euro volatility right now is around 6%. 1 month Bitcoin right now, anyone want to guess what it is, implied volatility? It's 85. So that just gives you an idea. It's more volatile than natural gas, any of these like jet fuel, all that kind of stuff. So even the fact that it's settled down quite a bit from where it was a couple of years ago, it's still, you know, it's really hard to model risk around that, both to trade the spot and then especially to trade the underlying, you know, options and derivatives markets around that too. So it's been a lot of fun, to say the least. That's a great question. So the solution that we've determined, the question is, what's the best avenue to move in and out of crypto to fiat, back and forth as the rails? So we've partnered with a company called Wire. They manage our fiat on-ramp and off-ramp. Most of the fiat on-ramp and off-ramp integrations at this point are still pretty slow and pretty low limit. So that's the biggest inhibiting factor is, I think the maximum for us is probably a couple $1,000s a week or something like that. Really the best gateways, if you're trying to move real money around and do it quickly, it's still bound by the ACH wire system, obviously, because you're still transacting in fiat. But the big venues in the US, at least like Gemini and Coinbase, are probably just the easiest, safest bet. That's what I would tell my parents. That's what I would tell, you know, any kind of enterprising, you know, trader at the moment, at least. Hopefully that continues to evolve, and especially with the advent of stable coins, I think we might get some really cool, there's some cool projects out there exploring the idea of reducing the friction between fiat and crypto, but those are still very much nascent at the moment, unfortunately. Cool, I can give you guys an extra few minutes to hang out. Feel free to come up and start a conversation with me afterwards. Thanks.